Hi, it's Friday, December 10th, 2015. Today I'll be talking about options, which are kind of derivative. Derivatives, I know, have gotten a very bad reputation in the last 7 years, since the great financial crisis of '08. Very bad publicity, and it's understandable. Derivatives, nevertheless, used responsibly, can be very useful tools for farmers, for producers, for investors, and even for speculators. Speculating is part of life. You know, people speculate. Any decision you take is a speculation in the end of the day. There's two kinds of derivatives, and that's very important in my opinion. You've got the exchange-traded derivatives and the over-the-counter derivatives, or OTC derivatives. In my opinion, the derivatives that caused the most havoc during the '08 crisis were the OTC derivatives, because they're not publicly traded, they're not on an exchange, very opaque. Even back in 1994, they bankrupted Orange County in California, OTC derivatives. So I don't recommend OTC derivatives. I'm a proponent of exchange-traded derivatives. Exchange-traded derivatives are basically traded on an open exchange with standardized contracts, and prices and information about who holds the contracts are published daily. So very, how can I say, open and, you know, not opaque. And also, you know, in exchange-traded derivatives, the traders or investors are monitored daily for risk exposure, while in the OTC derivatives, there are no rules except the rules that the writers of the derivatives, you know, make when they trade those with the users of the derivative, and it's not public at all. So I recommend exchange traded. Why did I become interested in options? Well, when I was still at university, I met a broker who knew a friend of my father, and I went to his office, and he explained to me that, you know, futures and options, and he told me that with options you could, you know, spend a couple of $100, and the most you could lose was $200, but you could make thousands, you know. And I thought, that's interesting, but at the same time, he told me futures are riskier because you have to put up thousands of dollars of margin, and you could lose more than you put in. So I thought, oh, this is interesting. I like options. You know, I didn't have much money back then. I was a student, and I've been a bit risk averse, even though I've worked as a futures and options broker after that for 20 years. You know, I was a futures and options professional for 20 years. What is an option? Basically, an option is like an insurance policy. For example, you buy an insurance for your car, and you pay a premium, you know, of $500 a year for that insurance. If you don't have an accident, if nothing happens, you lose that premium. You know, but you didn't have to use the insurance. If you have a bad accident and you've got thousands of dollars of damage to your car, that insurance you pay off, you know, will pay off. So, you know, it was worth having the $500 premium. So basically, an option, a financial option, is the same thing as insurance. Let's say, you know, you think the price of a certain commodity or stock will go up. You buy, you know, an option on it, a call option. Well, now I'll start and talk about the kinds of financial options that there are. There's two kinds of options. There's a call option and a put option. A call option is basically an option to buy something at a specified strike price. One example is for if you think that wheat, the price of wheat is going to go higher. Let's say wheat is trading at 10 cents. I don't know where the price of wheat, the wheat contract is at the moment. Let's just say it's 10 cents, the price of wheat. And you think wheat is going to, let's say, 20 cents. So you buy a call option with a strike price of $15, and it has a term of 3 months. So if within 3 months the price of wheat trades from 10 to 20, like you thought, you can exercise the call option. So you can buy the wheat contract at 15 cents and then sell it at 20 cents in the market. So you will have made $5. And if you paid, for example, $1 for that option, you have made 5 cents, not dollars, sorry, 5 cents minus that 1 cent, you've made 4 cents. But for example, on the other hand, if the price of wheat doesn't move for the next 3 months, it stays at $10, it won't be worth for you to exchange or exercise, that option at 15, because what's the point of buying wheat at 15 and selling at 10? So you will lose that premium, just like you lose the premium for car insurance. If you don't have an accident, you lose the premium of 1 cent, but you can't lose more than 1 cent. So a call option gives you the right to buy anything that's financial or commodity or otherwise at a specified strike price, and you usually have a period of 3 months, even though you can have 1 month options. They even do 1 week options now, but that's for further for another video. So that's a call option, gives you the right to buy at a certain strike price for a specified period of time. Put option is just the opposite. It gives you the right to sell a specified financial or commodity instrument at a specified strike price for a specified term or period of time. That's a put option, the right to sell at a certain strike price. Originally, options were mostly traded on agricultural commodities. They sprung up options market in 19th century Chicago. Chicago was the hub for the heartland of the United States, agricultural heartland, and the Chicago Board of Trade evolved in Chicago, of course, and commodities were traded by farmers, by the buyers of commodities, by speculators, and you also had options evolve in the Chicago market, and that became the Chicago Board of Options Exchange. Now those two exchanges have, well, a lot of the exchanges have merged into one in Chicago. An interesting point about options, they've been traded even before the 19th century. The Dutch, they were trading options on the price of tulips during the tulip mania in the 1630s. So just an interesting point there. Options are been around for a very long time, and yeah, interesting. Since the 1970s, the use of options have grown a great deal. Stock options started being traded in the 1970s, and in the 90s everything really kicked off, and the over-the-counter derivatives also mushroomed, and then you had late 1999, well, 1999, the Glass-Steagall was repealed, and the U.S. banks started getting involved in derivatives, OTC, and even exchange traded as well. So yeah, options can be traded now on anything financial, government bond futures, interest rate futures, currencies. You even have options and swaps, which are kind of over-the-counter derivatives. They're called swaptions. So there's a whole plethora of options that you can trade. And as I said, I recommend the exchange-traded options. Oh, well, the dangers of options, because there are dangers. I know I said you can only lose the premium you pay, but losses can be unlimited if you sell a call outright, or if you sell a call that's not covered. And by covered, I mean you sell a call on wheat with a strike price of 15 and wheat is at 10. You sell that for a cent. The buyer of that call, if wheat happens to go to 20, he can come to you and ask you to buy the wheat at 15 cents, and you have to sell it to him, and then you'll be short the wheat, and you have to go in the market and pay 20 cents for it. So you lose 5 cents, and you minus the premium that you received, the 1 cent, so you lose 4 cents. So that's the risk. Selling uncovered calls, or just selling outright as well, without having had that call, if you just sell it outright. And I start with call options because the risk is unlimited, because things can go to infinity. So you could really lose a lot of money. While selling a put uncovered or outright, you can lose money as well, but the price of a commodity or anything can only go to zero. Well, unless nowadays interest rates are becoming negative. So I guess even if you sell puts on interest rate futures options or interest rate swap derivatives options, I guess you have the risk with these central banks making interest rates negative. So that's changed kind of the nature of selling puts. So you got to be careful with those, but don't recommend doing those. So yeah, the basic risk then is that, if you sell these options outright or uncovered, calls, very dangerous, because the price move upwards is unlimited. It's tempting because a lot of people sell options, the professionals, because they take in the premium, and a lot of times these options expire worthless. But I don't recommend the normal investor doing that, and I personally actually don't recommend anyone really. The professionals do it because they know what they're doing. That's their business. They cover, they hedge. They see the market going up. So yeah, that's the big danger of options. Don't sell them outright. Your loss could be unlimited. So yeah, I hope you enjoyed this primer on options. If you have any questions, please comment below. Ask me any question you want about options, and I'll answer these questions. And hopefully, and I'll be doing more videos about options and get a little more, give a bit more details about the nature of options. Take care and have a good weekend.